Ever wondered why seasoned investors always emphasize the importance of financial ratios in stock investment? In the world of stock investing, it's easy to get overwhelmed by the sheer volume of data available. But fear not, financial ratios are here to simplify things, providing a snapshot of a company's financial health. Just as a doctor checks your vital signs to gauge your physical health, an investor uses financial ratios to understand a company's economic well-being. Financial ratios are mathematical comparisons of financial statement accounts or categories. These relationships between the financial statement accounts help investors, creditors, and internal company management understand how well a business is performing and areas of needing improvement. Financial ratios are not just numbers. They are tools that help investors make sense of a company's financial statements. They provide insights into a company's profitability, financial stability, efficiency, and growth potential. For instance, a high debt-equity ratio might indicate that a company has been aggressive in financing its growth with debt, which can result in volatile earnings. On the other hand, a low price-earnings ratio could suggest that the market has low expectations of a company's future growth. The beauty of financial ratios is in their simplicity. They break down complex financial data into simple, comparable metrics. This allows investors to compare different companies within the same industry, or benchmark one company against the industry average. However, financial ratios are not a crystal ball. They don't predict the future. They reflect the past. They are a starting point, not an end in themselves. They provide clues about a company's performance and potential problems. But to fully understand a company's financial health, investors must dig deeper, examining the company's business model, industry trends, and economic environment. In the world of investing, knowledge is power. The more you know about a company's financial health, the better your investment decisions will be. So it's essential to understand and use financial ratios as part of your investment analysis. By the end of this video, you'll have a clear understanding of these critical financial ratios. First on our list is profit margin ratio. It's one of the most fundamental financial ratios that you'll encounter. But what does it indicate? Simply put, the profit margin ratio gives us a glimpse into a company's net income relative to its total revenue. Now you might ask, how is it calculated? The formula is quite straightforward. You take the net income of a company and divide it by its total revenue. The resulting figure is the profit margin ratio, which is usually expressed as a percentage. Why is this ratio so significant? Well, it provides valuable insights into the company's profitability. It helps us understand how well the company is managing its costs and maximizing its profits. A higher profit margin ratio generally suggests a company that's doing well. A company that's keeping a tight rein on its costs. It's a company that's not just making money, but also keeping a significant portion of it. A higher profit margin ratio generally suggests a more profitable company that has better control over its costs. Next up is the debt-equity ratio. Now, this is a crucial ratio that measures a company's financial leverage. In simpler terms, it indicates the proportion of debt that the company uses to finance its assets. When we talk about debt, we're referring to borrowed money that the company must repay, often with interest. On the other hand, equity represents the shareholders' investment in the company. To calculate this ratio, we divide the company's total liabilities by its shareholder equity. Let's imagine a company with total liabilities of 1 million rupees and shareholder equity of 500,000 rupees. The debt-equity ratio for this company would be 2, meaning the company uses twice as much debt as equity to finance its assets. This ratio can tell us a lot about a company's financial health. A lower debt-equity ratio is usually more favorable, suggesting that the company isn't overly reliant on debt to finance its operations. Now let's delve into the price-earnings ratio. This ratio, often abbreviated as PE ratio, is a significant tool in the toolkit of any investor. It is a valuation ratio calculated by dividing the market price per share of a company by its earnings per share, or EPS. In essence, this ratio tells us the amount an investor is willing to pay for each unit of a company's earnings. To illustrate, let's say a company's current market price per share is $50 and its earnings per share is $5. By dividing the market price per share by the earnings per share, we get a PE ratio of 10. This means that investors are willing to pay $10 for every dollar of earnings the company generates. Now, you may be wondering, what does this ratio mean for you as an investor? Well, the PE ratio can give you a sense of whether a stock is overpriced or underpriced. If a company's PE ratio is high, it might suggest that the market has high expectations for its future growth. Hence, investors are willing to pay a premium for its earnings. However, a high PE ratio could also mean that the stock is overpriced and might not deliver a good return on investment. Conversely, a low PE ratio might suggest that the market has low expectations for the company's future growth, implying that the stock could be undervalued. But remember, a low PE ratio doesn't always mean a good investment. It could also indicate that the company is facing challenges that could affect its future earnings. So, how do you make sense of all this? It's essential to compare the PE ratio of a company with other companies within the same industry. This will give you a benchmark to determine if the stock is overpriced or underpriced relative to its peers. A lower PE ratio could mean that the stock is undervalued, but it's essential to compare this ratio within the same industry to make a meaningful conclusion. Moving on to the current ratio. Now, this is a liquidity ratio that measures a company's capability to cover its short-term liabilities with its short-term assets. Think of it as a company's first line of defense against financial troubles. To calculate the current ratio, we divide a company's current assets by its current liabilities. Current assets can be anything from cash, marketable securities, accounts receivable to inventory. On the other hand, current liabilities include accounts payable, short-term debt, and other similar obligations due within a year. This ratio gives us a snapshot of a company's short-term financial health. Let's say a company has a current ratio of 2. This means it has 2 times more current assets than current liabilities. It can comfortably pay off its short-term obligations twice over. In essence, a higher current ratio indicates a more promising short-term financial strength. So when you're considering investing, keep a keen eye on this ratio. Last but not least, the return on equity. This financial ratio, often abbreviated as ROE, is an indispensable tool for investors. But what exactly does it mean? In simple terms, return on equity measures the financial return that a company generates on the money that investors have put into it. To calculate return on equity, we divide the company's net income by the shareholders' equity. The result is then multiplied by 100 to get a percentage. This percentage is the ROE. Now, why is this ratio important? Well, it essentially tells us how effectively a company is using its investors' funds. Consider it as a measure of efficiency. If a company has a high return on equity, it indicates that it's able to generate more profit using the same amount of equity. So when you're evaluating a company to invest in, don't forget to check the return on equity. A higher return on equity ratio indicates that the company is using its investors' funds effectively. To wrap up our discussion on financial ratios, let's take a moment to reflect on the key points we've covered today. These financial yardsticks are not just numbers. They're the pulse of any company, providing us with a clear snapshot of a company's financial health. First, we talked about the profit margin ratio. This ratio is a clear indicator of a company's profitability. It tells us how much profit a company is generating from its sales. A higher profit margin ratio suggests a more profitable company that has better control over its costs compared to its competitors. Next, we delved into the debt-equity ratio. This ratio provides insights into a company's financial leverage and risk. A lower debt-equity ratio generally implies a more financially stable company. But remember, a zero-debt company isn't always the best choice. Sometimes companies utilize debt smartly to fuel their growth. Then we discussed the price-earnings ratio. This ratio allows us to compare the market price of a company's stock to its earnings per share. A lower price-earnings ratio could mean the stock is undervalued, offering a potential investment opportunity. We also covered the current ratio, which measures a company's ability to pay its short-term obligations. A current ratio of more than 1 indicates that the company has enough assets to cover its short-term liabilities, suggesting financial stability. Lastly, we tackled the return on equity. This ratio provides insights into how effectively a company is using its equity to generate profits. A higher return on equity points towards better efficiency in using shareholders' funds. In essence, these financial ratios are a roadmap to a company's financial landscape. They tell us stories about profitability, risk, value, liquidity, and efficiency. But remember, these ratios are not standalone indicators. They should be used in conjunction with other financial analysis tools and information to form a comprehensive picture. Remember, financial ratios are just one of the many tools to help you make a well-informed investment decision. Always do your due diligence before investing.